Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Tim joins us now. Tim, wonderful to see you.
Yeah, good morning. Good to see you.
You know, it was really interesting when I was reading your notes. You talk about how usually it's something of a sleepy affair. People kind of get together.
Pretty subdued in the spring.
Subdued, bureaucratic kinds of, hubbub. This is different. Why?
Geopolitical risk. People are concerned. You have war in Europe, war in the Middle East, which could grow, tensions in the Asia-Pacific. So it feels like a very dangerous world. People keep making allusions to the 1930s. I think that's probably overdone, but certainly something we should consider.
Part of the problem with some of these discussions is it's very hard to know how to prepare for something where it's a very bipolar kind of outcome. Are people actually hedging that kind of risk, particularly with the respect of the areas that might get hit hardest in the economy as a result?
Yeah, everyone's preparing because you just don't know. The uncertainty just overwhelms all calculations. The economy is good. As you noted, growth is exceeding what was expected this year. The U.S. economy is humming right along. So from just a growth perspective, we're exceeding expectations, but people are still nervous.
Is the U.S. economy too good in terms of it's so good here that it's dealing with some pretty fraught consequences around the world?
Well, I don't think it'd ever be too good. I think there is other countries looking and saying, how can we replicate that? And why aren't we doing what the U.S. is doing? The U.S. consumer continues to power ahead. So I think there's something to be said for that. Maybe lessons to be drawn from the U.S.
But the U.S. is doing more of industrial policy, especially fiscal policy, loose fiscal policy. The IMF report has talked about this. Do you hear other countries saying, well, if we're not going to have as robust global free trade, that's the direction we need to lean into?
Well, I would hope we go back to a robust global free trade. I think that's the right answer. The fiscal deficit, 6% of GDP, is not sustainable. There is a lot of fiscal support. Debt and deficits are part of the conversation this week. I think there's a lot of concern about where we're going to be and the sustainability. I don't think it's sustainable. But right now, it's providing a real pulse to the economy.
So let's take a step back and talk about what the main issues are that financial firms are looking at and actually trying to hedge against as they prepare for this more dangerous world in a whole host of different ways. You point to oil in particular and saying that it could surge 40% globally next year, or even this year, if you start to see a protracted and escalating conflict to the Middle East. Do you see firms actually preparing for that, or do you see them as incredibly vulnerable to a situation like that?
No, our firms are in the risk management business. They're all looking at different scenarios and have for some time. It's not a surprise that oil prices could surge, but it's energy prices generally, and that goes back to industrial policy. If you want to support manufacturing, energy prices are one of the most important component input to manufacturing. So it's not just throwing more fiscal dollars at a certain sector, it's how do you get energy prices at appropriate level.
I hear you talking about how they're prepared for it. They're in the risk mitigation business. We hear that in a host of different ways. Does that mean that you don't see the likelihood of some sort of banking crisis or some sort of banking kerfuffle, whatever you want to call it, akin to what we saw even last March, just simply because they are prepared for higher interest rates, they are prepared for higher oil prices, they are prepared for a potential slowdown?
No, the system is highly capitalized. We have a tremendous amount of liquidity, very good risk management systems. What we saw a year ago was pretty idiosyncratic. So I feel pretty good where the industry is, but every day we're spending an entire week scenarioing out different risks. So we are trying to think through what are the array of possible downside outcomes.
One risk that you mentioned when you talk about geopolitics that I thought was fascinating, you talked about the U.S. election, and that was actually one of the geopolitical risks that a lot of people were looking at. What are people expecting from a Trump presidency 2.0 in terms of either deregulation? Is that really the case? Can you game that out?
Sure. I just did a 9-city, 17-day tour across Europe. So the first question out of everyone's mouth, what's going to happen on November 5th, 201 days from today? And the concern is, what is a Trump administration? I think actually it'll be business friendly. I do think there's protectionism. I do think we'll see tariffs and non-tariff barriers. I don't think we'll see deregulation for our industry. I think that's come and gone. So I think there's a lot of potential chaotic outcomes, just the uncertainty of what a Trump 2.0 would look like.
What kind of tariffs do you actually see potentially happening? They talk about a 10% wall and all imports coming to the United States, and then 60% Chinese imports?
Yeah, I think it's just part of a negotiation, right? I think that's the opening bid. But I do think there's a proclivity to believe that somehow the biggest challenge we have in the United States is our global imbalance, the external imbalance, and we need to solve that particular equation. I don't think that's the problem. And I think you could end up doing some really bad policy in pursuit of an objective which I think is of secondary nature.
But whether or not it's Trump or Biden, you see the direction of travel the same when it comes to potentially more tariffs on places
certainly
like
on China. China is on the ballot irrespective of who's elected or who's running, yes.
Which raises the question for banks, and this is something that we've heard and seen quite significantly. If you're an international bank, do you get into China? Do you expand your presence? Or do you really curtail it in a more significant way? We saw yesterday Morgan Stanley pulling out a couple of its bankers from the region.
Yeah, I think it depends on the institution. You see some institutions who are doubling down and others who are withdrawing. It really depends on your risk profile, your appetite for risk, and where you're located. I think I'd be cautious being in China, but certainly you can't walk away from the second largest economy in the world. You have to be there, and your clients want you there. So I think you do so cautiously.
So this raises this question because we keep talking about how this is a whole new world, and there is an increasingly protectionist kind of feel at this IMF meeting, and this feeling that free trade isn't as good as it really was thought up to be. Is that the same tone that you're hearing from the members of the IIF?
It's a concern that we're hearing. You know, my industry tends to be for free trade, free flow of capital, free flow of data, free ideas, right? We think that's how you optimize growth. But we don't hear that coming out of political capitals. You hear politicians who think they can micromanage their economies into a better outcome. I think that's a huge mistake.
So what's the biggest risk then right now? Is it the politicians?
Well, it's the politician and misallocation of capital, which won't show up for years, but we can end up wasting a lot of capital pursuing sort of pipe dreams of politicians who think they can outsmart the markets.
So we're here for the IMF spring meetings. How does the IMF as an institution, do you think, really guide the global economy and companies that you work with?
Well, they can provide some intellectual framework, some analytical framework, which is if you choose A, B happens. So I think showing trade-offs. I think trying to hold the sector, the global economies are honest. You've got finance ministers, central bankers sitting around the table. They can be voices of reason. They can talk to the political leaders. Ultimately, it's about political leaders taking political decisions.
This morning, and I can't let you go without asking this because it's something that's very much on my mind, Vanguard came out and said, if you see Treasury yields go up to 4.75, they'll easily pop to 5. We have Jonathan Pingle over at UBS saying that the Fed could hike rates to 6.5% next year. Could banks withstand that?
They will. I don't think we're going to see a rate hike, but I don't think rates are going down either. And I haven't thought that for some time. I think rates are going to stay where they are. You know, the Fed has done a really remarkable job in inflation, but it feels a little sticky. We saw Governor Bowman last night talk about the stickiness. The last mile was always going to be hard. I don't know why it's a surprise, but I think we'll get there with time.
Well, that seems to be the tone that we're hearing from the Federal Reserve as well. Tim Adams, CEO of the IIF, thank you so much. Central Bank President and ECB Governing Council member Klaas joins us now. And Governor, President, all of the different ways that you weigh in on European central bank policy, what a fraught moment. How much are you looking to U.S. policy to determine how far the ECB can go on its own?
Well, obviously, monetary policy always takes place in a global context. But at the same time, we're not the 13th federal district. We have our own monetary policy. We have our own set of outlooks, economic outlook, inflation outlook. And as Christine already alluded to, some of the fundamental drivers of inflation have developed quite differently in the US than in the euro area. So we have our own monetary policy to do. That monetary policy, I think, is testimony of the fact that we're increasingly confident with the disinflation process that we have been seeing and that we expect to continue. We expect it to become a little bit more bumpy also down the road because of all kinds of technical factors that I won't want to tire you with. But we are confident that the overall picture is one of continued disinflation.
So you mentioned the B word, bumps, and this is something we hear a lot. What kind of bumps would you have to see to not cut rates in June?
Well, bumps that would lead me to fundamentally change my assessment of the ongoing disinflation process. And I think the projections that we have are pretty clear, that we are moving toward reaching our target 2% inflation over the medium term in the remainder of this year, course of 2025. But there are risks surrounding such projections, but increasingly these risks are becoming more balanced. Upside risks, I think, emanate predominantly from the labor market. And then it's not just about wages, it's about wages in combination with very slow productivity growth. That's also a major difference with the US. And the question about the capacity of firms' profit margins to absorb any increase in unit labor costs that might come from this combination of wages and productivity growth. That's the assessment we need to make. That's a risk on the upside. At the same time, we also don't want to undershoot our inflation target. We have a 2% symmetric target. We are zooming in on it, and let's make sure that we continue to do so.
So right now the market's pricing in a 25 basis point cut in June and then 2 more for the remainder of the year. You're basically on board with that if everything stays the same.
Well, I'm not uncomfortable with such market pricing, but at the same time, we don't pre-commit. We're data dependent. We go meeting by meeting. Of course, we have a picture of where we think the underlying movement is within the data. But we will have new data points, every month on inflation, every quarter on the labor market, and that will continue to inform our decisions beyond June.
Well, what would make you rethink what you have right now in terms of that path? Is it the geopolitical concerns? I'm trying to understand what would make the ECB change path, or how would they respond to, say, an oil price shock?
Yeah, well, an oil price shock obviously will lift inflation. That is absolutely true. But the question for us is the oil price shock of enough significance to trigger second-round effects? And there's an important difference here today with 2022. In 2022, all inflation items were going up, and we had the energy price shock as the consequence of Russia's unjustifiable invasion of Ukraine. Now, if we have an oil shock, it will be against the backdrop of general disinflation in all the other factors. So the likelihood of significant second-round effects, I would argue, is smaller, but it is clearly something to monitor. It's clearly something to keep in mind.
So you're willing to potentially look through it?
If it continues to be confined to energy prices only, yes. As soon as I get indication that it broadens into the consumer basket into more traditional goods and services inflation, then the answer would turn no.
Something that people have speculated is that the ECB might be willing to also look through depreciation of the euro in response to rate cuts at a time where the Fed is not cutting, as long as there isn't an oil price shock. So let's say that there isn't an oil price shock. Would you be willing to accept parity with the euro and the dollar? All things being equal, it's fine.
Well, the exchange rate in and of itself is not a target of our policy, so I can't comment on specific levels of the exchange rate. It's one input into our overall assessment of the inflation outlook. It's clearly that a depreciating currency would lead to additionally imported inflation. At the same time, if the reason for that is tighter monetary policy in the US, higher bond yields in the US, that would also spill over to the euro area, and we would have tighter financial conditions in the euro area as a consequence of that. Which of the two effects will dominate? It remains to be seen. That's very much state contingency, so that's difficult to comment on beforehand.
A very difficult question. Some people are speculating that high rates are actually helping inflation continue because people are earning more, and then they're able to refuel that into the economy, and that low rates actually were depressive of inflation. Do you believe that?
No, I don't believe that at all. I think it runs counter to decades of empirical evidence, and if you want to see what the consequences are of running such an experiment, look at Turkey, right? I mean, that's where the experiment was brought to life, and I don't think that that's seen as a paragon of central banking success.
Dutch Central Bank President, ECB Governing Council member Klaas, thank you so much for being with us. Really appreciate it. Pingle of UBS, he came out with a call that was nuanced, and I think that that's the important way of putting it, and I want to start there. You talk about how your base case is 2 rate cuts, but you made headlines by talking about the possibility for the Fed to raise rates to 6.5% next year. Put those two stories together. Please explain.
Well, I mean, the stories are, I hate to admit it, they are somewhat born out of our own forecast errors, right? So I think there's an element of needing to be humble here, but I mean, the basic fact is growth has surprised. persistently, for the last year or more, essentially. And, when we think about the central bank, we're all focused on inflation. They're very focused on inflation. But in the backdrop, they have this very strong labor market, strong headline numbers, retail sales. And at some point, if that is really what's preventing them from achieving their inflation target or making further progress, at some point they may need to push back on that. And pushing back on that would imply something, I think, a little bit more than just higher for longer, where they maintain the same level of rates and hope that that slows growth and they make this grinding progress down towards 2%. Because if the economy is going to remain sufficiently strong, non-farm payroll employment, 303,000, extraordinary number, but even if it's still running at this 244 average pace, eventually the unemployment rate is going to start moving lower, and that seems pretty inconsistent with 2% inflation. At some point, the central bank may think they need to do something about it.
Are you basically saying that if inflation doesn't come under control, the Fed's going to have to break something?
This isn't even about breaking something. This is like going from 244 to something closer to trend. It's really an extraordinary pace of growth. It's persisted for a while, and they might think that they need to break something in order to solve this sort of, I've been calling it sort of the last half-mile problem, like if they're stuck at 2.5. But I think if growth is going to be 3% GDP growth and 250 on payrolls, they're just, I think, they're going to end up coming to the realization that that is not going to allow them to achieve price stability.
We heard from Michelle Bowman last night saying she thinks policy is restrictive, but maybe time will tell if it's restrictive enough. When you see these kind of numbers in this kind of market and you have a probability, even though it's small, you are putting in a probability of a hike. Do you think the Fed is restrictive?
Well, I do think the Fed is restrictive, but I have to say I've been thinking the Fed is restrictive. And at the same time, I'm still not seeing the kind of slowdown I would have expected. You do see some evidence of restrictiveness. Equipment investment, a lot of different types of business fixed investment have been pretty weak. And that looks like it's the effect of higher interest rates restraining that activity. But overall, when you're watching consumption growth at the pace we've had it, it's very difficult to think that, well, you know what, is the neutral rate really the 0.6 in the SEP? So we've started thinking about a short-run neutral rate, but I will say it's hard to identify these things in models. It's hard to come up with a point estimate. So the Fed and we are really feeling our way forward. And I think as we feel our way forward, if growth is just going to remain super strong, at some point they might realize they need higher rates to kind of, tame the economic conditions that would engineer a path to 2%.
But back to your base case, you did push back your timing of that first cut to September. A lot of people are saying September, right?
Yeah, no, we did. I'm only laughing because we got the CPI, and I actually published the rate call change faster than we published our CPI write-up.
But why are you even having two cuts if this is what you're talking about?
Well, we have two cuts because we do think the economy is going to slow. We're looking at an expansion where the sources of growth have been relatively narrow. So we look at 2023 and we think there was a big impetus from fiscal policy. And we think we're seeing that fade, both in the pace of manufacturing plant construction that was supported by the CHIPS Act and the IRA, as well as sort of what we're seeing in public infrastructure investment, for example. And we're also seeing a fair amount of hardship in households. And we think that that is the recipe for a slower second half. But we've been thinking that that's a recipe for slowing. And the upper 20% of the income distribution remains awash in cash, liquid assets, and high levels of wealth.
So I think that Anne-Marie was going to September and this question around politics.
Of course.
Oh, yeah.
Because there's...
We're in Washington.
So, here we are. People are saying, can we actually get a September rate cut given the fact that we have one of the more contentious elections that we've had in a very long time? How do you push back and say, okay, if the economic fundamentals determine that this is the way to go, the Fed will just do it? Is that really realistic based on the climate we're in?
I think it is. I think it does put the onus on their communications to explain why it's unfolding. But when we look back at history, we've sort of analyzed the September moves. I mean, we can debate whether or not the start of a cycle is different than an ongoing cycle, but they do move in plenty of Septembers within 3 months of a presidential election. I just think their communications have been such that they've laid out this plan. They've been telling everybody that I don't think it would be particularly surprising if the data started to go their way. They're communicating it. I think November would be a challenge, 2 days after the presidential election. I mean, could you imagine waiting and then doing that? So I do think the odds of November should be pretty low to start an easing cycle, but I think September is probably okay.
Jonathan Pingle of UBS, thank you.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.